Hello and welcome back to Okcoin Live. I'm your host, Natalie Brunell. We are doing a women's spotlight for the month, so I'm honored to be co hosting this episode. And I have the honor of introducing macroeconomist and investment strategist Lyn Alden. She's one of the most followed voices in Bitcoin in this space, and I'm so honored to be talking to you. So thank you so much for taking the time, Lynn.
Thanks for having me. Happy to be here.
So, for anyone who doesn't know you, and that's probably going to be a rare few in this group because you're so popular in this space, tell us a little bit more about your background and sort of how you were first introduced to Bitcoin, just for a little bit of background.
Yes, my background is as an electrical engineer, and then I went into engineering management, engineering finance, and that's where I did a good chunk of my career. But I was always an investor. So even before then, I was an investor. During that process, I was an investor, and so eventually, I made a career shift from engineering and management towards investment research. And so I began a firm about 5 years ago to publish research for retail and institutional investors. And Bitcoin, like many people, I had to come across it multiple times before I really understood it and took the time to dig in. And so I first heard about it back in, somewhere around 2010 or 2011. I had a friend that was able to mine it back when you could mine it on your computer with a graphics card. And she was mining it, and I thought that was neat. And I got the basic idea of it. Like it was kind of a neat technical innovation. I didn't know how to price it, and so I kind of meant like, yeah, I should maybe mine it, and then I just didn't. So a very expensive decision. And then whenever it would have those kind of big price pumps, it would get in the news, and I would kind of go, "Oh, wait, now it's like $800," and so I would kind of keep tabs on it, and I always thought it was neat, but it wasn't until 2017 when it became kind of big enough to be like a macro asset, right? So it really got on my radar. I had a number of readers that wanted me to cover it, and so by then I initiated more formal coverage of it and became particularly bullish on it in early 2020.
Wow. I think a lot of people came in during that time, and it's been so interesting to see really the rallies over the last 2 years that got us to new all time high, 69,000. And then suddenly, a lot of people think that we're in a bull market, a lot of it impacted by the macroeconomic environment that we're seeing, which is exactly what you specialize in and you analyze. So let's talk about the current, environment that we're in right now, especially having to do with the outbreak of the conflict in Ukraine. We're seeing the potential breaking of the euro dollar system that placed America in its superpower status. So, could you speak to sort of what's happening in the big picture monetarily and how this could impact Bitcoin?
Yeah, so if we step back a little bit, something I've been covering for a while is the shortcomings of the existing global monetary system, which we can call the petrodollar system. And the way it works is that the United States has agreements with OPEC where they only export their oil in dollars. So it doesn't matter which country's buying it, it's all dollar based. And that's been in place since around 1974. And but that has kind of a secondary effect, which is that most global financing happens in dollars as well. So everybody needs dollars if they want to import oil. And then in addition, if an emerging market, for example, is developing and their government or their company wants to borrow money, most foreign lenders don't want to lend in their local currency, or if they do, they charge very, very high rates. Instead, they want a global currency. And they tend to default to the dollar. I mean, there is euro lending, there's yen lending. A lot of it is dollar based, though. And so you also have a lot of dollar denominated debt in the world owed by entities that cannot print dollars, like in jurisdictions that don't have access necessarily to the Federal Reserve. And so the combination of needing dollars for oil and needing dollars to service debt has been kind of the ongoing network effect of this dollar system that we've been in for about 50 years, more or less. And the challenge with the system is that over time, the United States is becoming a smaller percentage of global GDP. So when this system started, the United States was like 35% of global GDP, and we were the biggest commodity importer. But as we've seen the rise of especially emerging markets, and especially China in particular, now they're the biggest commodity importer. And the United States is 20 to 25% of global GDP, depending on how you measure it, and even less if you look at purchasing power parity terms. And so it's hard to maintain that one currency system when you're an increasingly small percent of the global economy. In addition, many countries obviously don't like the fact that one country can essentially sanction any other country and kind of cut them off the market. Now, in many situations that could be a diplomacy tool, right? So it's basically something other than war that countries can resort to when they're kind of trying to avoid countries doing extreme behavior. But from a game theory standpoint, if you're a country, ideally you prefer not to be sanctioned by one other country. And so we're starting to see kind of shifts over time. Countries have an interest in having their own payment channels, and some of the largest currencies have an interest in being able to buy oil in their own currency. And so I think that's the structure we've been kind of going towards. I've written about this a number of times, and one thing that this whole conflict does is accelerate some of the trends. We've already seen some diversification of global reserves over time. With the creation of the euro and then the kind of the slow rise of the yuan. We've seen some currency diversification. We've already seen Russia was already pricing oil in euros. We're already seeing arms deals between India and Russia priced in rubles. We were already kind of seeing that over time, but now what this war does is probably accelerates that. So you have, more partnership between Russia and China, less partnership between Russia and the Western world, and so I think we're seeing a bifurcation or a multipolar financial world kind of open up over time. So in terms of supply chains, could become more bifurcated, as well as payment systems and reserve practices of different countries.
Well, we know that China has been working on its central bank digital currency and kicked out, obviously, Bitcoin mining. Russia announced that it's working on one digital world currency for trade. The Fed is working on its own digital currency. So, what what does it mean for the world to have these competing monetary regimes, and how does that affect Bitcoin?
So a couple different ways. There's a spectrum here, and most of them are behind the curve. I mean, the president just did an executive order to research it, right? Let alone implement anything. Basically, research what to implement. China's been researching this since 2014, and they already now have a working CBDC. They've been ahead of the curve among major powers, and it's partially because of incentives. When you're the king of a system, you're less likely to innovate. And if you have a problem, you're more likely to try to innovate and find that solution. So China wants to, on the I guess on the good side, they want to be able to diversify their global payments. So they want to be able to have their own channels for payment, which is understandable. But of course, they also want to do things like surveil their citizens more, and CBDCs do give them those tools. And so they've been kind of spearheading that development. Now, there's a range of possible options here. So you can have central bank digital currencies, and from the policymaker standpoint, they can do things like negative rates more easily. They can track and surveil legal transactions, and that can mean different things depending on what jurisdiction you're in, right? So in some jurisdictions, illegal transactions could mean just the most extreme things like money laundering and terrorist financing and things like that. Or in many jurisdictions, that could mean free speech is blocked, right? So if you protest the government, you get your asset shut down, your payment channel shut down, your savings frozen. And so there's a big range between if you're Norway or China, for example, in terms of what you can do with a CBDC or what you would do with a CBDC. Then there's also kind of the intermediate step of say corporate stablecoins, where you can have public private partnerships, and we might see that emerge more in say the United States, where they're behind the curve in terms of launching a currency like that, but they have this long history of working with private entities. And so you could have, for example, bank issued stablecoins or other kind of large regulated stablecoins that have some of the characteristics of CBDCs, but have some armed reach separation between them and the central bank. So there's a spectrum here, and different countries based on their priorities where it will implement different things at different speeds. And so I mean, in some ways they're really good marketing for something like Bitcoin because uh, you know Bitcoin is a system that's no individual entity can shut down. There's still privacy improvements to make, and other tools that exist on higher levels that can help with that. So it's still possible to in some ways censor transactions, but it's challenging to do so. Whereas those other ones give a lot of centralized control to those entities. So corporations as well as governments can have a lot of control with a CBDC system.
Well, things obviously don't happen overnight. And we're seeing, even in this conflict between Ukraine and Russia, sort of the culmination of almost years and years of preparation by Russia and a lot of issues that have deep, deep roots. And so I'm kind of curious, as far as global reserve currency, how do you see an unwinding happen if the US dollar were to lose its status, and what that would mean for, say, the average American? I mean, what does it look like for America if it isn't the global reserve currency anymore?
So a couple things. One reason actually why China's been slow to catch on with their currency as a global reserve asset is because they're a closed system. And so, judging by the size of the economy, they should be, arguably the second biggest currency right now, perhaps the biggest. But because it's a closed capital account, it's much less attractive than dollars and other assets. Plus, they don't have those big network effects that we built up before. They haven't convinced a lot of oil producers to sell in yuan, and they're not a yeah, they're not a major funding currency. But really, it's that closed capital account that has made them slower to catch on compared to say the euro, for example. And one of the challenges, so now that say Russia's reserves are frozen, um, basically it kind of shows one of the downsides of the existing system. If you're a country, now you have to kind of question your reserve practices, right? The Wall Street Journal ran a piece called "If Russian reserves aren't really money, the world's in for a shock." And so in some ways that kind of mimics the closed capital account. Now, Russia has been preparing for this, and so they have a lot of self-custodied gold. They also have some yuan-denominated assets. But this war has been very expensive for them. It's cost them hundreds of billions of dollar euro equivalents in terms of frozen reserves. Um, and so over time, if we start to see more of a diversification of reserves or less global willingness to hold treasuries and dollar-based assets as reserves, there's a couple of things you can see. So one of the, we always think that a lot of people kind of characterize it as though having the global reserve currency is a good thing. And for a lot of entities, it's kind of a mixed bag, right? So there are a lot of entities in the country for which it is a good thing. And then there's other entities in the country for that it's not a good thing. And so one of the things I focused on in my research is that the US having global reserve currency status, what it essentially does is it adds an extra monetary premium to our currency compared to other currencies. And that sounds like a good thing. But also makes your exports less competitive because in addition to your revenue being denominated in dollars, your expenses are denominated in dollars, right? So your
Mhm.
wages, your taxes, your various expenses are denominated in dollars, and so that's part of the reason why the United States has run a structural trade deficit. Basically, there's so much demand for dollars that we have to get dollars out into the world, and we do that through our structural trade deficits. So our import power is stronger, and our competitiveness is weakened, except for the most high margin industries like software, healthcare, finance, things like that. And so for the everyday worker, if we start to see a diversification of global reserves, they shouldn't see a lot of change to them. They'd see both upsides and downsides. So their importing power could weaken, but you could see the benefit of reshoring and more export competitiveness that can benefit blue collar jobs and different types of manufacturing jobs, kind of real world jobs. Now, most right in the current system, most of the benefits accrue towards the upper middle classes and the upper classes. And so, if you work in, say, a service oriented sector like healthcare, government, technology, you're getting most of the upsides of the current system, and you're not really getting a lot of the downsides. And so for them, that can be destabilizing. You can essentially have less import power and more inflation overall. And so one of the kind of the models we can look at is how UK lost their reserve status over time. In the kind of the first half of the 20th century. And it wasn't one specific event. There were a number of events that chipped away at it as a rising power came and kind of usurped them over time. And they had a currency crisis, they had an inflationary period, just like other countries did. And so for them, it wasn't necessarily disastrous, but it was this kind of loss of prestige, global power. And overall, I would say it impacted policymakers more than it impacted the everyday citizen in the UK, right? So the UK lost global influence, but they still had a reasonable standard of life compared to other developed countries. And so I think the United States can go through a similar period where a lot of what we look like right now is the UK in the early 20th century, I would say.
Wow, that's really interesting. Well, so do you see the Bitcoin being a threat to the US dollar as the reserve currency or an ally?
So I think it depends how much they use it. I think right now, in the very current snapshot, it's too small still, despite the fact that it's grown considerably. I mean, there's $13 trillion in U.S. denominated foreign debt in the world. There's something like what is it? Over $7 trillion in official reserves denominated in treasuries, plus more in terms of bank accounts and other things like that. And so you're comparing that to an asset that is currently worth less than 1 trillion and is more volatile. And so at the current time, we can understand why they've been slow to look at it, because when it was only worth tens of billions and then hundreds of billions, it's still not a huge contender compared to the dollar. But if it continues to reach, say, multiple trillions, then it becomes an interesting competitor to the dollar, or more specifically, the treasury, right? The idea that you can hold something long term that is outside of the dollar based system. Right now, I would say the biggest competitor to the dollar is still gold in terms of, say, official central bank holdings, but it's about rate of change, right? So we're seeing different countries kind of explore the use of Bitcoin as an alternative. In addition, unlike gold, Bitcoin also presents an alternative payment channel. So the ability to make difficult to censor transactions globally. And so we've seen some central banks dabble in that. And I think over the long run, if the network effect of Bitcoin continues to be very robust, and if adoption continues to grow, and if the market capitalization reaches multiple trillions, and if volatility continues to inch down as it's more widely held, that does become an increasingly interesting alternative to the dollar. Now, like I said before, the current dollar system isn't even necessarily benefiting the U.S. anymore, right? So
Mhm.
we've had to run these big trade deficits, and that hurts a lot of people. And there's analysts like Luke Groban, for example, that are pointing out some of the ways that actually China is kind of using the dollar system against the United States. So you can argue that back in the 70s when the system was established, it made a lot of sense because it essentially helped the U.S. win the Cold War against the Soviet Union. It helped us kind of gain influence over the Middle East. It helped our economy a lot. But in the 90s, when you had the fall of the Soviet Union, you had the opening up of China. We basically probably should have reshuffled the system, basically changed some of the incentives around, but we didn't. And so what happened was we continued running these massive structural trade deficits. We actually accelerated them in the 90s. And what China did was China then became a large surplus. They were on the other side of a lot of that, along with Germany, along with Japan and others. And what China did was China would take all these dollar surpluses, and they used to buy treasuries, and they used to buy other, they used to help fund U.S. deficits. But then what they increasingly began doing is instead saying, okay, we don't want to hold treasuries anymore, right? They're sanctionable, their yields are below inflation. So instead, what China began doing is using their dollar surpluses to buy up all sorts of foreign infrastructure and foreign assets around the world, commodity deposits, infrastructure lending. They basically lent to a large portion of the developed world as part of their Belt and Road Initiative. And so they're kind of in some ways using the dollar system against the U.S. And so I think over time, if the U.S., if they resist it, it's very hard for them because if you get the reserve currency kind of changed without your consent, it can be very painful. But if they see it coming, if they see the fact that just due to technology, due to global economic trends, payment channels and reserve practices are kind of diversifying. If they get ahead of that trend, then they can use it for the benefit of reshoring and use that over time and have a more graceful exit from the prior system. So I think it depends how good policymakers are dealing with that. And I would say so far they're not really getting it. So I would say so far it's not looking great.
In the last few weeks, we've seen this spike in commodities amid the crisis in Eastern Europe. And what's interesting is when we talked even earlier in the year, you seem to almost predict that there would be sort of a rotation from growth stocks into commodities, and you predicted the volatility and the choppiness that we're seeing. So can you add maybe a little bit of nuance to what's happening with energy and the precious metals and wheat and all of these commodities that are now surging? Because I think right now, if you watch mainstream news, it's just like Russia's causing your gas prices to go up, and it's oversimplified. And I think a lot of people are wondering like what's actually happening and how's the market moving.
So we can kind of break that into two eras. There's pre-war and then the current conflict that really accelerates things. So I've been talking about inflation and commodity shortages and higher commodity prices for a couple years now. And it's mostly due to the supply side. So generally, when you have these long commodity cycles, the way it works, because it's a very boom bust industry, when prices are low, nobody wants to come in and put capital into the space to start like a 5-year project for getting more metal or getting more energy. They want to either not invest at all, or they want to do smaller short term things like shale. Um, and so when you have that bear market, which we've been in, it kind of eventually creates the conditions for the next bull market because not a lot of new supply comes online. Eventually, those supplies get dwindled. Demand usually keeps growing up over time as population increases and as the developing world consumes more per capita. And eventually, you get a squeeze and you get higher price and you start the next cycle. So we had that already happening under the surface. And then we also have things like ESG mandates and large divestment. You actually add fuel to that fire. And so, even though oil demand has not increased very quickly in the past couple years, we've had supply shortages. And then the problem with that system is if you have a very tight market, it only takes small changes to give you pretty big price spikes or shortages. And so, when you started to get lack of investment, we're already seeing, for example, even before the war, we saw some crises in Europe related to natural gas prices, and that was before any conflict with Russia and the Ukraine. And now going forward, now that you have obviously, war in Ukraine, you have sanctions between Russia and the Western world. Russia can even pull back on some of their commodity exports. Now there's a couple big things at play. So one is that Russia is one of the biggest wheat exporters. Russia is, of course, one of the biggest energy exporters. Russia is also a large exporter of fertilizer, nickel, and other key things, including, nickel's heavily used for electric vehicle batteries and other kind of green technologies. And so there's a lot of markets that have trouble working if you just entirely remove Russia from the equation. And so a lot of the sanctions haven't even done that. A lot of sanctions haven't even tried to remove Russian commodities because they know that Europe and the rest of the world needs them. But you still have, for example, a very unclear situation where some private entities don't want to buy Russian assets because they're not sure if they're going to be able to unload those assets for the prices they expect. They don't want to have like laws change while their ship is full of Russian oil, for example. And so you kind of had some self-sanctioning because of just lack of clarity. And so right now we're kind of adding fuel to the fire. We're getting some commodity price spikes that are unusual, but I think it's still part of a broader trend of just there's not a lot of investment, there's not a lot of new supply. Copper was already looking, rather undersupplied. Nickel already had a long-term undersupply problem. I would say energy, oil and gas already had long-term undersupply issues going forward, and so this just kind of brought forward, I think, a lot of things. Kind of like how if you look at COVID, work from home
Mhm.
technologies were going to get better and better and better anyway, and you were going to have that trend anyway, but you compress it all into a short time period because everybody had a sudden incentive to use it. And I think kind of like how you know what could have been, say, a 3 to 5 year commodity thing is getting compressed into a shorter period of time because you have a catalyst related to war, related to some of the supply coming offline in an already tight market.
There are Bitcoiners who feel strongly that oil is going to eventually be priced in Bitcoin. Do you agree? And if so, how do we get there?
So basically, it obviously has a connection to energy in the sense that oil and gas can, for example, use their spare, they're basically their if you collect oil out of the ground, if you have associated natural gas and you don't have a pipeline for it, you can, for example, instead of burning that natural gas into the atmosphere, you can use it to mine Bitcoin, right? So it's already a connection between energy and Bitcoin, and specifically Bitcoin mining. Now, entities that don't want to sell in dollars could sell in a number of different other payment channels. They can sell it in euros. They can trade it for gold, right? You see this sometimes in places like Iran or other countries that have to kind of go around the system. They're kind of, they're sanctioned, but there's still some trading partners that want their stuff. And so they have to make these other types of deals to go around the system. And Bitcoin, as both an asset and a payment channel, is obviously interesting for any sort of exporter, let alone an energy exporter. And so if the Bitcoin network continues to get bigger and bigger and more stable, it can be used for either a payment system or a store of value system for some of these larger entities. And so it's a natural fit. The caveat right now is that they don't like the volatility of Bitcoin, but you can use Bitcoin the network without even necessarily using Bitcoin the asset. Like we're seeing with Strike, for example, with smaller payments, you can do similar things on a larger scale, especially as the network grows. And so I wouldn't be surprised one day to see more commerce happen in the Bitcoin network, especially if we continue these structural adoption trends we've seen over the past 5 to 10 years.
Well, let's talk a little bit about Bitcoin's price. You forecasted that it would be choppy for at least, probably the next year, if not longer. And right now, what's interesting about that is the global events that we see playing out are such a value proposition for Bitcoin, right? For the fact that it's censorship resistant and borderless, permissionless. Everything from the Canadian truckers protest, where we saw average citizens' bank accounts frozen just because they donated to a crowd funding platform, to now, Ukrainians needing to flee with their entire savings, to Russian citizens being cut off from traditional payment rails. So it seems like all of these are putting a spotlight on Bitcoin and showing why it's so valuable and useful. But we're really not seeing too much of a spike in price. We did get back over, the 40 range to 45. Now we dip back down and going up again. And I mean, why aren't we getting closer to that 50, 60 range that we used to be at, when all of the things around us seem to be pointing to why Bitcoin is so important?
So one thing to look at is what large pools of capital are going to do, right? So I agree with you that the use case for Bitcoin, the argument for Bitcoin is more clear today than ever before. But in terms of it really was it's fund flows that determine the movement of an asset price, especially in any kind of multi-week, multi-month period. And so one thing I've been pointing out, for the past few months, is that if you look back historically at Bitcoin's price, you have the 4-year halving cycle, for example. Bitcoin generally done well after halving. But another way to look at it is that it's generally done well during rising PMI environments and has done poorly during falling PMI environments. And so PMI stands for Purchasing Managers Indice, and it's kind of a rate of change indicator for the economy. And you can look at it in multiple different countries. I'm referring to the US PMI as one of the largest economies. And generally, when you have that falling PMI environment, it's not necessarily that you have a recession, otherwise, but you can. It just means you have an economic softening. You have a slower period of growth that could become a recession under certain circumstances. So in the prior, say, 10 to 12-year expansion, we had about 3 cycles of rising PMI, falling PMI, rising PMI, falling PMI, and until the end of that period, until we kind of were running into COVID, we didn't really get an actual recession. And so when you have those falling PMI environments, generally risk assets, highly volatile assets, including Bitcoin, have struggled. And so, many of us might not view Bitcoin as a risk on asset fundamentally, but just because of its volatility profile, a lot of large pools of capital will put it into that risk asset bucket. And so, when you have this sort of situation, you naturally have a lot of risk managers looking to de-risk their portfolio, which for them means lower volatility. And so they'll trim things like Bitcoin, or at least maybe not start new investments in Bitcoin,
Mhm.
while they have this kind of risk-off environment. And so my base case is that anything can happen, correlations can break down, right? But that generally in a falling PMI environment, it's just generally challenging for Bitcoin. It's like a headwind, right? So everything else
Yeah.
can be going well, and that's just this ongoing headwind. So what we've been seeing is that if you look at on-chain indicators, the supply side looks great, right? So obviously we know the supply cap, but I mean in terms of say the percentage of supply held by very strong illiquid hands, over the past year, we've been in this choppy market. A lot of the coins have moved from short-term traders to longer-term traders, from accounts that have a higher propensity to sell to accounts with a very low propensity to sell. Kind of the supply squeeze. But that's only one side of the equation. You need demand if you're going to get a big
Mhm.
price increase, and just that demand has been somewhat lacking around the margins. There are people that say, "Oh, this is what Bitcoin is," and they buy it, but you don't really have these large pools of capital coming out and saying, we're going to put $1 billion in a Bitcoin now. We get it. I think that's something you might see in the next rising PMI environment. So I think what we're in now is we're setting up. The supply side's very tight, and we're kind of setting up for the next bull run. And it's hard to say when it starts. Maybe we've already seen the bottom. I think there's a decent chance we've already seen the bottom. Just because we're chopping around doesn't mean that you can't chop around in a mild bull market
Yeah.
until you get some sort of catalyst that gives you a renewed bull market. Or we could just chop around sideways, even go a little bit lower. It's hard to say for sure because it's a very volatile asset and it's
Mhm.
kind of based on a small number of new billionaires coming into the market or not. If you get a couple Michael Saylors, that just changes everything. All the models are broken, right? So it's hard to actually give that kind of near term price prediction. But I'm generally bullish long term while being kind of uncertain for a 6 month
Mhm.
period because we're in this kind of choppy risk off environment in terms of macro.
Yeah, no, that's really interesting. And obviously, Bitcoin has benefited a lot from QE since it was created in 2009 and after the financial crisis. So, I want to talk to you about QE a little bit and sort of the macro response that we might see over the next couple of months, because the Fed obviously says it needs to reduce the balance sheet, that it's going to hike rates. Some people within the Bitcoin space and macroeconomists say, hey, that won't happen, or they're going to have to ease off the gas pedal because the market can't handle it. Others say the inflation is going to run way too hot. So, what do you think is going to happen, and how's that going to impact equities and Bitcoin?
So I think the Fed is going to try to tighten mildly until something breaks. And even before this war, I mean, that's you had the falling PMI environment and you had the Fed try to tighten into a falling PMI environment, which is actually kind of unusual. So normally the Fed tries to tighten into a strong market. They
Yep.
say, okay, the market's strong. This is our chance to get off zero. This is our chance to stop doing QE. Um, and right now, because of high inflation, they're trying to do it, or at least talking about trying to do it while PMIs are actually falling. And so that's kind of the big challenge. That was, pre-war, that was my big risk off concern is all of that happening. Now the war as another factor because if you have high gasoline prices and high energy prices in general, that's less money that consumers can spend on other areas. And so you have this risk off environment. Now, the Fed has a dual mandate where they want to have what they call stable prices, which they define as 2% inflation based on the way that they measure inflation. And they also seek low long term employment. And right now, the employment measures they look at are pretty strong, while inflation is obviously way above their target. And so, and that's that hurts a lot of people right now. Gasoline prices going up, wheat prices going up. The problem is a lot of that is outside of their control. I mean, they've contributed to it by having very easy money conditions, but a lot of this is due to supply things we talked about before. But what they're going to essentially, they're trying to do is rein in that inflation to regain confidence in the market that they have a handle on price stability. And the challenge there is that that's hard to do when you have a decelerating economy. When you have an economy that is either no longer it's either growing at a slower rate or it even starts to go flat or even shrink mildly. It's very hard to tighten monetary policy into that environment. And so I've been generally taking the under on estimates, so I don't have a specific price range or for what they're going to get the Fed funds rate up to. But up until this war, you had investment banks kind of tripping over each other to price in more and more rate hikes. They were like playing a game of like who could be the most hawkish. And I was saying
Yeah.
like I don't know what number we're going to get to, but I'm going to take the under on this consensus. And that got more complicated by the war. And so, you know, the Fed's not going to
Mhm.
stop tightening if markets, when indices fall 15%. They're not going to stop tightening when you just have dislocations. It's really about watching what the credit market does. Do junk bond
Mhm.
markets freeze up?
Right.
Do high yield spreads, high yield bond spreads, their yields compared to treasuries, do they widen sharply? Does that market become a liquid? Is the treasury market becoming a liquid? Those sort of things could eventually cause the Fed to reverse course and not continue tightening, and to even, say if they stop QE, they could restart QE. I still think we're a little bit while away from those. But if you do start to get severe dislocations and recession indicators, and specifically problems in the credit market, that's when I would see the Fed probably pull back. So right now, my base case is that they at least try to tighten. It's kind of like the old college try. Like Powell wants to be like we tried. We tried
Mhm.
to we didn't just ignore it. We tried to tighten into it. And one of the research I've done over the past few years is that this period looks a lot like the 1940s
Right.
rather than the 1970s. And so in the 1970s, you had high inflation, but you had very low debt. And so
Mhm.
you could raise rates sharply to try to
Yep.
contain that inflation. And you would cause a recession, but you wouldn't cause like a depression. You wouldn't cause like
Right.
a global insolvency event.
Yeah,
In the
like a
40s,
bust.
exactly. But in the 40s, because you had so much public debt because you were fighting the war, federal debt to GDP was over 100%. They couldn't raise rates despite the fact that they had high fiscal related, commodity war inflation. And so they said, you know what, we're going to hold rates at zero anyway, even though inflation's running hot. And so my base case has been low rates, but high inflation. And so that's what we've been seeing now. And I still think that's going to continue for a long period of time. I think the 2020s, when we look back on it, will be a decade where inflation levels were on average much higher than interest rates around the world.
Wow. Well, Shifting gears a little bit, I just wanted to say that recently I watched your interview on what Bitcoin did about wealth inequality. And it was fascinating because it is so nuanced and people just want to blame it on the money printer. But you dug into so many different aspects of how wealth inequality is actually caused. And then obviously how Bitcoin could perhaps level the playing field a little bit. So I wanted to know if you could summarize a little bit of your outlook on, could Bitcoin be a solution to some of the wealth inequality that we see, and could it redistribute some of the wealth that has made life so hard for the average American?
Mainly what Bitcoin does is that it's fair and undilutable, right? So it doesn't necessarily on its own fix, I don't like to call it wealth inequality. I like to call it wealth concentration because
Hmm.
no one should really expect wealth to be equal.
True.
But when you start to see extreme levels of concentration, especially if they're driven by misguided policies that help, feed that concentration, that's when it becomes a problem. You usually get rising populism. You get a breakdown of the
Hmm.
social contract. People rightly perceive that, it's kind of rigged against them, the whole system.
Yeah.
And so that's the kind of wealth concentration I talk about as being a problem. And Bitcoin can address that in the sense that, unlike fiat currencies, it can't be diluted, right? So it gives people more control over their own savings, assuming the Bitcoin network continues to be successful, widely adopted, and working as intended. And so that gives people that kind of self sovereignty. I think it most helps people in developing markets and in emerging markets and in refugee situations, right? So in many cases, it gives tools to the most vulnerable among us. I think in that way, it can help global wealth concentration. And then in developed markets, it can kind of reduce financialization, this kind of Cantillon effect that we've kind of built up over decades, and give more power to the people in terms of saving and appreciating scarce asset. And so in that sense, I do think it's a factor that can contribute to just kind of better wealth concentration aspects going forward. But I think it's one piece. Basically, in order to not have the extreme wealth concentration, you need a lot of changes compared to what we've seen over the past couple decades. So I don't think it's like a silver bullet, but I think it's a really important tool that can act as a catalyst and act as kind of an initial thing for people to use to kind of go around the existing system, kind of build their own financial system on the side, and have more control over their own payments and their own savings.
Yeah, I love that. I mean, one of the things that inspires me about this space is how many people are pushing for Bitcoin being a tool to have this more egalitarian society. And you're right, it's not going to all be equal because we all have different talents and skills and motivations that we bring to an economy. But at the same time, it won't feel so rigged and people won't feel so left behind because right now the system is so skewed and manipulated. To start to wrap up, I know that you've already shared your outlook that you're bullish long term, but it's going to be choppy right now. But out of curiosity, I mean, what sorts of things are you looking for? Right now, I feel like the amount of news and information, especially because of the conflict that's happening right now and the macroeconomic environment, it's like things are coming at us from every direction. So, you personally, Lynn, what are you looking for? What's the maybe the best case scenario that you're predicting, and maybe what's the worst case scenario that you're hoping you don't see?
Well, I think the best case scenario is kind of a de-escalation of some of the military conflict that's happening in Ukraine right now, and for kind of the next cycle to start, right? So right now we're in a declining PMI environment. Most economic indicators are pointing down. Um, uh, you know, that eventually reverses one way or another. It could be that they try to do stimulus again, right? Or it could be another factor. Basically, the endless money printing kicks on again, right? So right now, when we're in this kind of trend, trends tend to be sticky until they're not, right? So until we see catalysts that this trend is changing, it's just generally a defensive environment. That doesn't mean you can't get strong counter rallies, and that doesn't even necessarily mean that it could be that the Bitcoin bottom's already in, and that we already seen maybe the worst, and that we're just kind of chopping up, maybe chopping sideways to up. It's hard to say for sure. Um, and so I think this is a really strong accumulation period for Bitcoin. I think it's a good period for dollar cost averaging, recurring purchases, things like that. It's just that as a trading call, it's something that I think it could go either way in the next few months. And so what I'm looking for is kind of this economic deceleration cycle to turn into an economic acceleration cycle on the other side of this, and that could be next year. That on average, those timings tend to be about 3 years for those cycles. And so we've been in kind of this period since late 2021. And so we'll see how long that goes. Now, that doesn't mean the whole downturn lasts 3 months. It's kind of like a whole downturn and upturn generally lasts 3 years. I mean, and so when you're in this kind of 12 to 24 month kind of downturn, that's just challenging for a lot of risk assets. And so I think that right now I would characterize it as I don't see a ton of catalysts that are bullish, but that long term I'm bullish, and that those catalysts can come very quickly, right? So a couple months from
Mhm.
now, you know, by the time you identify the catalyst, sometimes the market has already moved, which is why I say I wouldn't be shocked if the Bitcoin bottom is already in. And so I think basically if you're a long term accumulator, that this is a great environment. Most Bitcoin metrics are in the kind of value territory where they're kind of on the low end of their long term trend ranges, and that overall I think it's a good kind of space to buy long term. And what you generally want to see is a catalyst that would bring more demand into the space because right now we have very good supply dynamics and very weak demand dynamics. And so I think that can change over the next year. And then right now I think it's a good accumulation zone.
So you don't think that an initial rate hike or balance sheet reduction attempt would trigger another bottom?
I think it absolutely could. That's what I'm saying. I don't know if the bottom's in or not, right? So
Mhm.
if I were to paint the negative picture, war doesn't de-escalate anytime soon. The
Mhm.
Fed keeps trying to tighten, and they until you get a more extreme market dislocation. So maybe equities down another 10 to 20%, credit markets start to break.
Mhm.
Bitcoin has a liquid downturn as kind of highly leveraged entities have to sell it. You
Mhm.
could easily get another deeper bottom, right? That's not out of the question at all. You could
Yeah,
go below 30,000, for example. Um, so that's I wouldn't be shocked to see that outcome, which is why I'm just generally defensive.
got
So
it.
that wouldn't be surprising, and also if we've seen the worst, it wouldn't be surprising. But I do think that overall we're in that choppy environment until we see some kind of improvements, some sort of catalyst that should say, okay, now we have more of a green light, more kind of beneficial, kind of smooth sailing ahead.
Got it. Well, all right. I mean, Lynn, it's always so fascinating to talk to you. We could go on for hours, but just wanted to open up. Do you have any final remarks, anything you really want people to know as they're watching all of this news play out? And where can people find you?
So one thing I shared in one of my latest letters is that a lot of what we can do is outside of our portfolio, right? So we can continue accumulating the assets we like, such as Bitcoin. But another thing we can do is just make sure our personal lives are solidified against shocks, right? So our global supply system, as we've seen over the past few weeks, is rather fragile. It's all based on just-in-time deliveries, purposely low inventories, so that companies can maximize their return on invested capital. And one way to offset that kind of fragility is to have households be more robust. So it doesn't mean hoarding and prepping, but it means kind of mild hoarding and prepping. Basically, have a stockpile. Don't assume that the global supply chains are going to work 100% of the time smoothly because they're not, especially during challenging decades. There could be cyber attacks. There can be all sort of dislocations in the market. And so I think having a reasonable stockpile of foods and paper products and I like to have these battery chargers that I use for travel that can store like multiple cell phones worth of electric charge. And if you just leave them unattended, they just keep that charge for months, right? So things like that, simple things you can do to have access to things you might need during a challenging period. And I think things like that are good to build up over the coming weeks and months just to have. I think this will be a decade where having a non-zero amount of preparation will give you periods of safety and comfort in this kind of challenging time. And so I think that's something I focus on other than just purely investment decisions. And my research is at lynalden.com. I do free newsletters, public articles, and I have a low cost research service.
Yes, I love how Peter McCormick described it as scandalously cheap. So everyone make sure to check out Lynn's newsletter. Thank you so much, Lynn. And you're watching OK Coin Live. We are spotlighting the leading women in Bitcoin and crypto. Really grateful that I had the chance to speak with you. And to learn more, go to okcoin.com.
Thank you.